obviously set our goals up with Dashdot when we signed up, and we had our own personal goals too. And they've far exceeded where we thought we'd be currently, to be honest. Yeah, so the property in WA has grown more than what we anticipated, and we anticipated to buy our new PPR, but we were looking at getting our second property towards the end. I know we're getting towards the end of this year, but end of this year, start of next year. So we're probably six months-ish in front of where we kind of plan to be with Dashdot, of getting that second property. And then, it's just once that settles and we move in, we've actually got quite a long settlement, which is handy, so we can get a bit of growth before we actually put any money down. So once that actually, so we don't settle until start of December, which once we settle, we'll kind of evaluate all our numbers and see where our next play is at.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. Joining me today, another one of our very special clients that we have here at Dashdot. We're talking to Matt Russo. How's it going, Matt?
Good, mate. How are you?
Yeah, good, thanks. Now, I'm really excited to have you on the show today for a very specific reason, and that is one of the things a lot of people often talk to us about is doing value adds to properties. They buy it, they might do a reno, or they might hold it for a little bit and then flip it. Now, this is an area where you have a lot of experience, right?
That's correct. Yeah, we've kind of been on both sides of that spectrum of that buy and hold strategy, but also the buy and flip strategy. It's been a journey.
All right. Well, let's start now with what your portfolio looks like at the moment so that we sort of have an idea of what the target that a lot of people can be aiming for. What does your portfolio look like at the moment in terms of number of properties?
Currently, we're at 2 and in the process of getting our third at the present stage. So we're just actually cooling off, finished yesterday for our third property, which is exciting. So we have a current PPR here based in Adelaide where we are. And we bought our first hold investment property through Dashdot a year ago in WA in Bunbury.
Okay. I've got some pretty awesome numbers on that I can share with everyone. That was in Harvey and WA, and the purchase price was a little over $500,000, right, 540, and there was a val that happened in May. Now, May, at the time of this gets released, is going to be at least 6 months ago. And at that point, it was $624,000. So we're up $84,000 already. And I can only imagine that you're going to be somewhere north of $650, probably pushing $670, maybe. So overall, the equity growth in that's been pretty awesome.
Yeah, it's pretty phenomenal, actually. Obviously, when you sign up, you hope for and you trust that Dashdot's done their research and we've done all our stuff. But getting over $100,000 in less than 12 months or almost, we're super happy with the result.
Well, what I'm really interested in is how this compares to what you've been able to do when you're flipping. Now, you're a builder by trade?
I am, yeah. We run our own building company, Concept Building Renovations, here in Adelaide. So we've been operating for close to 10 years now.
Okay, what was the name of the company?
Concept Building and Renovations.
Concept Building and Renovation. So anyone in Adelaide, if you need a little bit of help on your property,
yeah,
shameless plug there.
Yeah, shameless plug. Yeah, no, we're here. We do mostly renovations and extensions, which is pretty much what we've done in our property journey as well. So when we were younger, without kids, we bought our first house, and it was really that stepping stone. I think sometimes people want the big fancy house to start with, but we knew obviously we couldn't afford it, so we went and bought a block. Quite a large block back in 2013, 2014. So we were quite young, 1,200 square metres with a pretty old rundown house on it. We ended up renovating the house and subdividing the block. We put a hammerhead at the back and sold the back block of land separately, and then did an extension to the front house.
Okay. And so how did that sort of perform from a pure numbers financial perspective? How did that go?
It went really well, actually. The process happened. We sold the block pretty well instantly, subdivided straight away, and it took 6 months, I think 9 months to end up by the time we went through all the paperwork and selling. And then But by the time we did the extension and the renovation and then found our next place to move into, it was 3-4 years later. So we had a bit of capital growth in there as well. But I think we ended up turning over close to 350,000. So.
Okay, so if we're looking at two options here, we're looking at the flipping versus the buy and hold. Buy and hold, you've gone up by about 100K maybe over the course of a year, you mentioned. Flipping and doing all of that work, you've gone up by 300K over the course of how many years all up?
I think it was about four years, something like that. Yeah. So,
okay. So the run rate's comparable, right?
Yeah, it's pretty comparable. Yeah. So that was our first property. We've done a few other ones other than that, but pretty comparable on that one. Pretty straightforward. Yeah.
What were the other ones like?
So we moved on to our next project was a buy and a subdivision. We were still pretty young, probably not the best investment, looking back. Obviously, hindsight's a great thing. We bought a block and subdivided it, and the frontages probably weren't ideal in the area. People were looking at the double garages rather than single. So we ended up making about 50 grand in the deal, which, look, it's not wrong, but ended up taking us almost a year to get the house subdivided, get through council, sell the blocks. So that was a lot of money tied up in that when you kind of compare that Dashdot again. And there was a lot of paperwork and time and effort that kind of went into that subdivision. So it was a little bit disappointing in the time frame it took as well, because we basically, by the time we bought, settled, subdivided, and sold, it was close to, I think, 11 months, I think it was. So that was probably a stepping stone that we didn't need to take, but it was a good learning curve on where you can't always have the greatest returns, but I guess it was good we didn't lose any money on the project. And we ended up flipping, next we went to a unit. So we ended up flipping a unit. We bought a unit here in Adelaide, and I just saw an opportunity where lower, not run down, but, original style units close to the beach here, selling for low threes, and renovated units were selling for high fours. So I just saw an opportunity where we could go in and renovate. So we bought one, I think 320, we bought 330, we bought four, and we ended up putting about 50 grand into it, and we sold for 465. So we ended up I think we ended up making about 70 grand, and that was only in 3 months, 4 months, something like that. By the time we bought, we renovated it, and we sold it straight away. But that was full-time work. So I stopped my other projects and ended up going full-time on that project. So it's a high comparison where, the Dashdot project in like the property WA, it's been a set and forget. We did a bit of paperwork. Sam did all the paperwork for us. We just signed a few documents and send an email every now and then, and it's kind of running its course, where when you're doing the flips, it's time intensive. You're exchanging time for money, basically.
Right, and that time, I guess, has an opportunity cost as well.
That's correct, yeah.
Time you're not running your business. And what if there's some continuity stuff that you need to have in the business that you're running or something like that? You've probably, over those 3 months that you were doing that renovation, you're probably turning down a few other jobs.
That's correct, yeah. That's correct. Okay. Well, the business was still young, so that's why we take those opportunities. But, that was it. The opportunity cost is always the hardest part of turning down work or not doing work compared to doing our own stuff is always the difficult juggling act.
That's the hard calculation. And how many properties have you flipped in total?
We've still got one more after that one. So we bought our next PPR, which we ended up moving into, which I think is, most people on the podcast might know is a good tax reason to do. So when you move into a property and you live in there for over a year, you don't pay your capital gains. So we did that. We moved from our original house into a nicer house, a bigger block, a bigger footprint of a house. And we ended up renovating that house, and we stayed there for 5 years. And we went remarkably well with that house.
Okay, so buying the right principal place of residence for your budget at the right time can actually be a really good thing. I know that we've been pushing this idea of rent vesting because it's a relatively new concept. And so we've been talking about that a lot at Dashdot. But there is also the option of, if you do get the right principal place of residence, something that you want to live in for a while, and then maybe flip it later or use the equity growth. As long as you're getting that in a decent area that's going to serve your portfolio long term, nothing wrong with it. So that's awesome.
I think buying within your means is the biggest point. I see a lot of people now, their first home is $1.1, $1.2 million. I think that's just a a crazy thing. So our first house we bought, I know obviously the market's changed and medium house prices have gone up a lot, but we bought well within our means, well, even below our means of what we were approved for. Then our next house, we upgraded from that, but we used the equity to upgrade. So it was kind of a straight swap in our mortgage. And then, our current house, so we bought our current PPR in December last year, did a renovation to the current house that we're in now, and then sold that second PPR that we had and did well.
Okay, so you've done a lot of flips, and yet now your focus is not really on flipping. Would that be accurate?
Not at this stage, no. Yeah, obviously, like we discussed, time is a big thing. So in that time, we've had two kids, two little boys, which are hell raisers, to say the least.
How old are they?
4 and 1. So, very, very hands-on, very, very busy. And it was just about kind of trying to bring back a bit of time in our lives. So my wife and I, obviously we run a business which is already very time heavy. And we just didn't have the time to sit on realestate.com finding places. It's just another project that we had to handle. So we made the decision, start of last year, that we wanted to, we always, we've already done property. Property's always done very well for us. But we figured that unless we got someone else on board with us to help, find the properties for us, we were just never going to do it because we just didn't have the time to find anyone. And then through a couple of podcasts that I listened to, found Dashdot, and the journey began.
I'm very interested to know if you hadn't had the kids and if you still had lots of time, knowing what you know now. So not going back 5 years and making a decision then, because you probably would have continued flipping because that's what you knew. But knowing what you know now about the relative ease and relative difficulty of flipping versus buy and hold, what would you do right now if you didn't have any kids, you had all the time in the world? Which strategy would you go with and why?
Well, that's a good question. I'd probably, I think a mixture of both is a great option. Like, I don't think there's a one size fits all, and I think each property has its own merits. Like the unit that we did, I would have loved to have kept, but at the time we bought, renovated, we were going to be sitting negatively geared by, I think it was about $20,000 a year. And at the time, we just couldn't afford that with our current mortgage on the house that we had. So it was just that pressure thing. So we could either withdraw, obviously selling withdraws the equity. You get that equity straight away, you get that cash in the bank, but you don't get that future long-term growth, which is the play that we're going for now, essentially, is that long-term growth rather than drawing equity out. And that's what we had to do. So I guess at the time, you just do the best you can. You do the best of the opportunities that are in front of you. And now, because we're more on top of our PPR loan, we have the opportunity to buy and hold, which obviously you get that, long-term growth and that capital growth.
Right. That's really interesting because, you have a high level of expertise in building, right? You run your own company that builds and renovates and everything like that. And here you are saying, actually, buy and hold still works too. I'd probably do both. If you didn't have the building expertise, would you consider doing flips or renos, doing the value adds and having someone else do them? Or is it only because you have the expertise and you know how to do it and you can actually physically do the work yourself that it makes sense?
I'd be very nervous if I didn't have the expertise and the knowledge behind me to know what I'm doing. If I was going to try and do a flip, I know people, try, and we've actually been engaged with a few clients that have bought houses to renovate and flip and have just got in over their head, and we've kind of come in and started and finished the whole renovation, because trying to get trades these days, obviously we've got a crew like our tradespeople that we use all the time here in Adelaide, and I know trades are short everywhere. So trying to find people to try and do work these days is just an extremely difficult thing. So if you were just someone off the street trying to find people from the Yellow Pages or, wherever online, it's a headache to say the least for me to try to organise everybody, let alone if you didn't know anyone and know how to structure things and know how to, how to get what order of what trades, and you lose a lot of money if you don't do things in the right order because things aren't ready or things aren't done in the right place. You should have gotten this person first, and now they can't finish their jobs and have to have a callback, where obviously having that knowledge, our projects run pretty smoothly.
Okay. Well, this is really interesting for me because we have so many people that I've spoken to over the course of, I've been involved in property in Australia for probably about 15 years, working with various different companies in the space, from finance to property marketing through to developers and builders, and sort of like the full gamut. And it's really interesting to see somebody who has all of the expertise. Like so many people are a bit of a one-trick pony in that it's like, this is what I do. And it might be renos. It might be I do splitter blocks where I get, Brisbane's great for these because Brisbane was divided up in the UK where they have the narrow long blocks. People used to buy one big 810 metre block and then they would put a house in the middle. So they'd buy the two blocks, put the house in the middle. Now you can buy that old house in the middle on the big block, split it into two, and that's a strategy that works for some people, and they just really hone in on that. Some people like other things where they can do a value add. Some people like other things where they're looking for 3-packs or 4-packs or just retirement villages. It's interesting to see somebody who's basically changed tack a fair bit and gone from something that was very much like doing renos would very much be in your wheelhouse with all the expertise, shifting over and going, actually, you know what? This way makes a lot of sense for me as well. And I think maybe, obviously, you mentioned circumstances played into that, right? Having the kids, you don't have the time, you need to look for what else works. And it turns out that this new thing, the buy and hold, seems to be working as well as what the flips were doing. It was sort of comparable, maybe not exactly, but in the ballpark.
Yeah, in the ballpark. Yeah, I'd say it's fairly rare for someone. We've done 2 subdivisions, we've done 4 flips, and we've owned 3 PPR properties, and now we've got 2, well, soon to be 2 investments. So we've kind of had a pretty broad brush of all things, and to be honest, most of them, other than the buy and hold, take up just as much of your time. It doesn't make a difference if you're flipping or you're subdividing or you're building. It's just a huge chunk of time out of your day and out of your week and your year. So I think really it's hard to say because obviously, no one knows. But if we didn't have the kids, our strategy would be significantly different. But the whole point for us of building wealth and building, a foundation for our family is to buy back time, is to get more time with our kids and having more that opportunity to spend time with family and not having to go to work and do those sort of things. So it was finding a strategy for us that worked and worked with our lives as well, which was the big thing, because obviously we've done strategies that work, but currently those strategies don't work with our lives. So that was the big thing of making it fit with us.
I think your new strategy of buy and hold, I call it new. I guess it's new for you guys.
It's new for us, yeah. I think people have been doing it for a while.
Yeah, for most people, it's their plan A, right? It's like plan A, buy a property, hold it. Yeah, that works. That's all right, right? They don't want to go through the difficulty and the time sink of trying to do the value adds. I think the market at the moment is primed for the buy and hold side, right?
Yeah. Well, obviously we've found that. Yeah.
Yeah. At other times, maybe go back 10 years. If you're in southeast Queensland, for example, there 10 years ago, the market wasn't moving very much. If you wanted to make any cash, the smart move seems to be doing the flips. So it's also being sort of strategy agnostic and working out, okay, if I'm thinking about what to do next, how to build my portfolio, accumulate wealth, and that sort of thing, the market conditions obviously play into it. And at the moment, buy and hold seems to be like a good ticket. If you factor in how much cash is it going to cost me to do this, how much am I going to make, but also how much time is it going to take, and also what are the risk factors. And buy and hold at the moment feels very, very low risk, very, very low time, and returns that are comparable or probably right now, probably a little bit better than trying to do the flips.
Yeah, I think when you're young, you've got an abundance of time. You can go to work from 9 to 5 or 8 till 4 or whatever your time is, and after work you don't have responsibilities. But I always, I did a lot of research and a lot of reading, a lot of podcasts, a lot of that sort of stuff. And you want to always think about when you're working, whether that's at work or dealing with property or investing, what your hourly rate is and what you'd be charging yourself out as. So when we were younger, we were happy to work. And when we were doing our flips, we quite literally, one day when we did our flip, I worked the entire 24 hours of the day. I didn't go to sleep. Like, got to work at 8 o'clock in the morning, and I worked all the way through the night, all the way through the next day to get the job finished before we had to get it finished. But now that just sounds ludicrous to me because, but when you're young and you're 22 and you have nothing else to do and things need to get done, you just got things done. So I think now that buy and hold makes sense, where, like, even if I was looking to do a flip now, I think for houses in Adelaide, at least, I can only speak for, because I don't know anything about property anywhere else, obviously. The in prices for houses that need renovating there isn't a big enough gap between the low price and the high price in a lot of suburbs at the moment, because housing's so short, people are just happy to buy something and get something and they'll deal with it later. Where when we started flipping, even with the unit, the in price was 300, the out price was high fours. So there's 150, 200 grand difference, where now, that in and out price is very, very comparable, even if it's nice or not nice, because there's just nothing around. So it makes it very difficult to know your numbers on a flip, because they're so tight. You need to really pick the right property to know what your in price is going to be, but more importantly, well, not more importantly, but as importantly, your out price, and then obviously the bit in between, which, if you don't have the experience, is the hard part to calculate. And even having the experience, is hard part to calculate sometimes.
Yeah, it is. Like, I used the example of a splitter block before. Say you might be able to buy the splitter block and you work out how much it's going to cost to knock it down, build the two properties on it, and then you work out what you should be able to sell it by, factor in maybe a little bit of growth, and then you can work out what the profit is going to be on the deal. But what a lot of people who own splitter blocks do is they factor in that developer margin. They go, well, it's a splitter block, so you'll be able to sell it for more, so I'm gonna build that into the price now. And if someone has a large property and they work out how much you can renovate it for, they might know those numbers already. And so they can go, well, I'll take a little bit of the renovation margin on this as well. And they start building into the price that they're going to sell at in the current market. They start building in what the potential of the property is. Does it have potential to be subdivided? Does it have potential to do a splitter, a knockdown rebuild? Does it have the potential for a granny flat on the back? What is the potential? And they're factoring that into the price that they're selling at. Whereas 10 years ago, people were doing that a lot less. And you could go around, you could find people that hadn't done that. You could say, okay, well, they haven't factored in much developer margin. I can go in there, I can do a good job of this, I can make some cash. Whereas now, the margins are super tight and there's risk involved. Am I going to be able to get the tradies in? Am I going to be able to organize and streamline everything so that I get in and out on these timelines? Because if you don't, and you're holding it, and you're not getting any rent while you're doing the value adds and things like that, it's the old developer's dilemma, right? You're basically going to run out of time and money soon enough.
Yeah,
and
for sure. Yeah,
and there isn't enough of a miscellaneous fund there for the expenses that you haven't thought of that pop up. Sometimes you need to dip into, and that kills your deal, right?
Yeah, that is a big one. Yeah, everyone thinks. They'll look up, I don't know where they come up with numbers sometimes of how much a kitchen would cost or a bathroom would cost. And that's just normally, a base number. But that doesn't include when you start taking the walls apart, or your piping need to be redone, or your plumbing's not connected properly, or, the current house that we bought, when we started ripping apart and there's white ants throughout the whole floor of the entire house. So we had to basically replace our entire subfloor throughout our entire house. So if this was a flip, it's not planned to be a flip. We plan on living here for a long time because we moved into a zone where we want our kids to go to school. But if it was, that's a big that's a big chunk to the bottom line of profit that we're making. And there's just, there's no way to know that before you start, because you can't get to underneath your floors before you buy the house.
And that's what the miscellaneous fund is for. And a lot of people don't view the miscellaneous fund as this will probably be expense. A lot of people look at it, they put it into their fee though, but in the back of their mind, they're thinking, yeah, but I'll get that back at the end as well. But chances are you won't.
Yeah, I know sometimes people say miscellaneous can be to 2 to 5%. Some people say 5 to 10%. But that covers, yeah, on a good day that'll cover. But I've been in the game for long enough. I know on a bad day that doesn't get close. Yeah.
So I guess we're sort of working our way around to a fairly rational conclusion that in the current market, flips probably not quite worth it. Buy and hold definitely seems to be worth it because time, money required, extra capital to build stuff, it all just seems to work out a lot better if you're buying and holding at the moment. But this is probably a really good time to put in the usual disclaimers. This is not financial advice. We can give you property advice and general advice only, but it's not financial advice. Talk to professionals, blah, blah, blah. Just, yeah, imagine that I said the whole thing.
Yeah.
So on that note, it sounds like you're fairly well set up at the moment. You've got your principal place of residence. Financially, things are sort of going all right at the moment?
Yeah, no, we're moving along we obviously set our goals up with Dashdot when we signed up, and we had our own personal goals too. And yeah, they've far exceeded where we thought we'd be currently, to be honest. Yeah, so, the property in WA has grown, more than what we anticipated. And we anticipated to buy a new PPR, but we were looking at getting our second property towards the end. I know we're getting towards the end of this year, but end of this year, start of next year. So we're probably six months-ish in front of where we kind of plan to be with Dashdot, of getting that second property. And then, yeah, it's just once that settles and we move in, we've actually got quite a long settlement, which is handy, so we can get a bit of growth before we actually put any money down. So once that actually, yeah, so we don't settle until start of December. Which once we settle, we'll kind of evaluate all our numbers and see where our next play is at.
Okay, and what is the big plan?
The plan changes a lot. Yeah, it used to be, you used to read all the books and do the thing. It's 10 properties will give you 100 grand in passive income. That was, the original goal that everyone talked about probably 5 to 10 years ago, something like that, when we kind of started this whole journey out. But the more and more you look at it, the more you think, how much you need invested and what your ROI is on your investment. And it's just working out those numbers on, a lifestyle factor of what we think we need, and then what our return on investment is. So it's quite easy to work those numbers out, through your calculators of what your ROI is. And once we get to that point, then, yeah, whether that's 3 properties, 5 properties, 10 properties. I think we did talk about in our original meeting, looking at maybe going into commercial property as well, but that's obviously a whole different ballgame, which we haven't entered. That's probably the one part of, the property journey we haven't crossed that line. We haven't crossed yet.
Commercial property tends to be something people look at down the line. Once you have a robust portfolio of residential properties where the risk factors are much lower, depending on how much you're going to borrow. Because I know of cases where when it comes to commercial property, and this is a hot topic, a lot of people love talking about commercial property because they see the rental yields and they're like, oh, that's yielding 10%, 15%, something like that, which on paper sounds fantastic. And you're thinking, well, if I borrow at 5 or 6 or 7 from the bank, I'm making a pretty awesome margin on a property worth could be in the millions. But the way the bank evaluates property, the valuation on a commercial property is based normally on the value of the tenancies that are on that commercial property. And so if you have a couple of tenants who go away for a bit, who disappear, go under, or don't renew their leases or something like that, if that's empty for too long, then the bank says, all right, well, we've revalued that commercial property. Instead of being worth 2 million, it's now worth 1.5. And you need to make sure you've got 30% equity in the deal, so you need $500,000. Do you have $500,000? No, not really. Oh, okay, well, we'll take the property off you then. And so you do, I've literally seen pretty much that exact case happen. And so, a whole lot of equity that they've built up is just sort of disappeared overnight because they over leveraged into a commercial property. If you have a really, really good base of residential properties and you've got plenty of equity there, and the mortgage or the borrowing on the commercial property isn't too high, then it can work out fantastically. Then it can be absolutely brilliant. But it just does come with a little bit of risk if you are a little bit overexposed or over leveraged. So that's kind of why the commercial property tends to be a bit of a sort of like down the road way of converting equity into really good cash flow, as long as you can do it in a really safe way. That's kind of the approach that most people take.
Yeah, we have a probably higher than most people's sleep at night factor. I know, people like to leverage pretty high and push, the LVR up into the 80s, 90s, paying lender's mortgage insurance, that sort of stuff. But we're keeping our LVR at a pretty low, very reasonable level, just for, obviously our building company is doing very well, but anything can change. I could break my leg, or something could happen, or, for instance, something could happen. All our jobs dry up for whatever reason. Can't see why. We like to make sure that we're not over leveraging, and everything that we've worked for is going to get taken away like that. So yeah, definitely looking at commercial, but down the track, because we don't want to, like you said, have that over leveraging, push the button too far, and then, tenants leave and we sit vacant for 3 months or 6 months, and that's putting pressure where we don't need pressure to be put, really.
Yeah, it can take a while to build up a residential base. It can take a while to build up a really good portfolio, and it can take an extraordinarily short amount of time to ruin the whole thing by going into the wrong development or the wrong commercial property or something like that. And suddenly, I've seen it myself. People might spend 5-10 years building a portfolio. They make a couple of poor decisions on deciding, I'm gonna leverage up and I'm gonna do this block of 10 units or something like that. Something happens, builder goes under, someone gets fined, there's asbestos, all those little problems that can happen on something like that. They're over leveraged, and their portfolio was used as collateral, and it's bye-bye. And then they have to go all the way back to the beginning and start again. So I really like your approach. I really admire your approach. So often we're told these days, be ambitious and leverage up, and this is how much more you'll make. But the stress that can put people under may not always be worth it. And I really admire the fact that you're taking a more pragmatic approach in terms of the stress that it puts you under. I mean, with a young family and everything like that, you want to be showing up for them in a good mood, not freaked out and stressed out.
Yeah, that's it. With a crystal ball, everyone would have bought 10 properties, 2020, and you would have been fine. But then also, we were actually looking at doing a deal in 2020, actually late 2019, and finance reasons it fell through, and we were thrilled because COVID came around and everyone thought property prices were going to drop 30%. In the end, it went the other way, and no one's got a crystal ball, but it meant, if we bought that late 2019, I don't think I would have slept for half of 2020 until prices started going back up, because we wouldn't have been able to afford it. So there's a big thing which I think a lot of people disregard of. It's always good on paper, we can leverage to 90%, 95%, we make this amount, redraw and all that sort of stuff. But once you start seeing those numbers in your bank account of, $1 million, $2 million, $3 million that you owe into the bank, and the banks come and knock, and they're taking their money whether you like it or not, it can get pretty nerve-wracking.
Yeah. And the banks, in my experience, they don't have a great sense of humor when it comes to that sort of thing.
No. Their mortgage payments come out of your bank account whether you like it or not. So either they're taking the money or they're taking the property. That's pretty option A or option B. There's not really an option C.
Yeah. They get their cash back and they don't really care about anything else.
No, yeah. So, and it's just on just a personal thing for us. We just never thought we wanted to push that far and risk. We've been doing this for, we probably bought our first property close to 12 years ago now. So, it's been a long journey, and we don't want to risk that 12 years worth of hard work because we're just trying to get there a year sooner or 2 years sooner or whatever it is. Would rather just let the ship take its course and go on that path that it's going on rather than trying to push it too hard and risk it.
You sound like you're in a really good, really sort of balanced place when it comes to all of this. It's sort of like, yeah, everything's cruising along. Could go a bit faster, but why? Why not just wait an extra year and I mean, you're not exactly on easy street just yet, but I think maybe when you can see it a certain distance away and with a level of confidence, then that sort of maybe that makes life all feel a little bit easier.
Yeah, I think it's different. Obviously, if we sat down and we had this conversation 2 years ago or 4 years ago or 6 years ago, we were in that grind mentality. We were, when we built our first property, and you know, if someone told me this now, I'd say they're insane. But we bought our first property, our deposit was 90. We bought the property for 500 grand and we had 50 grand. So we were less than 10%. We ended up borrowing up to 95%. We ended up having to borrow, I think it was 6-7 grand from the bank in a personal loan to cover it. It was like we were absolutely to the brim, and we were 21 and 23 and young and, you know, probably a little bit dumb, to be honest. And I think that probably worked in our favour, because now if I knew what I know now and the risk we actually took, you know, I'd say you're crazy to take that big a risk. But when you're young and those risks are there, I think you can take them. But obviously the older you get and the more your life changes, that risk factor changes. And that mentality to grind, I don't think goes away, but I think just changes. I think we're obviously still very motivated to push and motivated to get where we want to get to, but just in a different way. And just trying to find a way that's going to work is what we're aiming for at the moment.
Yeah, I think also when you're young, you sort of, the appetite towards risk is, well, if it totally falls to pieces, I've got 45 years to earn it back. Whereas as you approach 40, it's like, this really has to work. And so the attitude towards risk changes a little bit, and it's like more about certainty and confidence than it is about, oh, look at these returns if everything goes perfectly kind of attitude.
Yeah, well, it's obviously the big craze in, you know, crypto and that sort of stuff. It's when you're young and you know, you've got a bit of money and you want to take the risk, take the risk. You know, if you lose it, well, then just earn it back again. It's not that big a deal. You don't have to go out and buy diapers and buy food and pay for a mortgage and that sort of stuff. But once you have those responsibilities, it changes your appetite for risk. At least for me, at least for us, it did. Yeah.
It's certainly, I've been in that sort of situation where you go through a cash flow squeeze. Maybe you just acquire another property or you start a new development or something like that, and you have that cash flow squeeze because you're always sort of thinking, oh, can I make this deal work? What's it going to take? And it can become a bit emotional. Maybe you don't want to let go of the deal or something like that. You know, the numbers, the upside looks fantastic. And so you end up borrowing, like you said at the top of the show, you've borrowed within your capacity, like comfortably within your capacity. You haven't overextended. And yet so many people these days, we overextend thinking, oh, but the returns are great. And through that overextension, the stress and pressure that it can put on you for like 3, 4, 5, 6 months. And these days as jobs change and things like that, put it this way, I'm very happy that I don't have to go through another one of those.
Yeah, so am I. Trust and it's easy to obviously say now because we're in the situation we're in, but we did, you know, we did that when we started out. We were stretched to the max, and it wasn't just our first project. We were stretched to the max on most, probably the first 3 to 4 that we did. We were right up to the brim of where we could get to, and looking at doing our spreadsheets, make sure we can cover all the mortgages and making sure we cover everything, and especially with the renovations as well. Obviously, you've got to pay for those renovations until you sell, and then once you sell, you need to wait your 30 days for settlement, and then you're thinking we just need to get this money back into our bank account so we can, you know, have another breath. So you're just holding your breath for 30 days until settlement day. But
it's very character building though.
It is, yeah, you know, and if you don't do it, you don't know. And when we've done it enough times to now, you know what it feels like and know what that pressure is. And it is character building, to say the least. It's something that I don't desire to do anymore. But look, if we didn't do it, we wouldn't be where we are now, basically.
Right. So it's character building. It's worth it when you're young. But just about everyone listening to this podcast right now, this episode, has reached a point or will reach a point where it's like, you know what? I don't want to keep on doing this. I'd like to chill out a little bit and just relax, have a property portfolio, watch it grow, not over leverage, stay comfortable, and get to easy street in a more rational way.
Yeah, I think it's about just reassessing, and if you're listening, like, people listen to property podcasts, you're obviously into property, you're thinking about that sort of stuff. And I think we were into property very young, probably younger than most. I don't think a lot of 21 and 23-year-olds are looking at doing subdivisions in houses. But, I was very aware from a young age of the opportunities that were in property and what there was. So I think setting those goals early on and having a strong goal was important to us and got us to where we are now of knowing where we wanted to be. And then revisiting those goals as well, like re-looking at not only the goal, but how you get to the goal too. So how you're getting to where you want to go and what you want to do. Because originally we were planning on doing 2 flips a year for 20 years. That's, after the first flip, that's what we thought we'd do forever. We never thought of being where we are now. And then when we did a subdivision, it was like, oh, we'll do subdivisions now from now on. But then that moved to the next thing of, now we'll do this and do that. So we're never being set in your ways, I think, is also a good thing of just being flexible and taking the opportunities that are in front of you and looking for those opportunities too is the big thing.
100%. All right. How far away are you from hitting the big goal that you have?
In terms of time?
Yeah.
We were actually sitting down trying to work it out last night. We're aiming for it within that 5 to 10 year mark. We'll be close to the goal. If we pushed a bit harder, we might get there a bit quicker. But I think we kind of sat down and just worked out and just reassessed, which we try and do, fairly quarterly. My wife and I, of just why push. 5 to 10 years isn't that far away, and I'm fairly young in terms of my journey where we're going to be. Why push it? Why try and get there in 3 years when we can get there in 7 years and enjoy the ride a bit more? I don't think sometimes the end goal is important, but the journey sometimes is just as important as well. And if you're not enjoying the journey, you're not enjoying time when you get there and you're stressed all the time, which we have been lately. It's nice to just, maybe not take the foot off the accelerator, but just ease back a little bit would be nice.
I understand. All right. Well, I think that's a really, really good message on which to wrap things up. Matt, thank you so much for appearing and sharing your experience and sharing your views on property and how your plan, how you're moving forward and everything like that. I think it's been incredibly valuable for everyone listening. So
no worries at all. Thank you for having me. No, it's been great. And Dashdot has been great on our journey and we're really happy with the partnership that we've joined with Dashdot. It's been a great thing. So.
Awesome. All right. Well, that's the best thing I can hear, really. So on that note, thanks everyone for listening, and we hope you'll tune in for our next episode as well. Thanks very much. Bye.
Thanks.